Hey everyone, welcome back to our channel where we make finance fun and easy to understand. Today I'm breaking down the income statement, one of the most important financial documents out there. Whether you're a business owner, an investor, or just curious about how companies track their performance, this is for you. But don't worry, I'll keep it simple and easy to understand. No complicated jargon, just straightforward explanations. So, what is an income statement? You might have heard it called a profit and loss statement, or P&L for short. Well, think of it as a report card for a business. Just like a report card shows how well a student is doing in school, an income statement shows how well a company is doing financially. It shows how much money a company made and spent over a certain period. This period could be a month, a quarter, or a year. This document helps you see if a business is profitable. In other words, is the company making more money than it's spending? The income statement is divided into three main parts: revenue, expenses, and net income. Let's start with revenue. This is the top line of the income statement. Revenue, also known as sales or income, is the money a company earns from selling goods or services. It's the total amount of money brought in before any expenses are deducted. Imagine you have a lemonade stand. All the money you get from selling lemonade is your revenue. Next up, expenses. These are the costs a company incurs to earn its revenue. Expenses can include things like rent, salaries, utilities, and materials. These are the costs a company incurs to earn its revenue. Without these expenses, the company wouldn't be able to operate. Going back to our lemonade stand, expenses would include the cost of lemons, sugar, cups, and maybe even a small fee for your marketing efforts. You might also have to pay for a permit to sell lemonade. Basically, any money you spend to keep your lemonade stand running. These costs are essential for your business to function. Finally, we have net income. This is the amount of money left after subtracting all expenses from the revenue. It's often referred to as the bottom line. This is the amount of money left after subtracting all expenses from the revenue. In simple terms, it's your profit. It tells you how much money you actually made after covering all your costs. In simple terms, it's your profit. If your lemonade stand brought in $100 and you spent $60 on supplies, your net income would be $40. Easy, right? If your lemonade stand brought in $100 and you spent $60 on supplies, your net income would be $40. Easy, right? This is a simplified example, but it captures the essence of what an income statement does. An income statement typically covers a specific period, like a month, a quarter, or a year. This helps businesses track their performance over time and make informed decisions. It gives you a snapshot of how well a business is doing financially during that time. It's like taking a financial health checkup for your business. One cool thing about income statements is that they help you make better decisions. By analyzing the data, you can identify trends, spot potential issues, and plan for the future. For example, if you see that your expenses are eating up too much of your revenue, you might look for ways to cut costs. Maybe you find a cheaper supplier or reduce unnecessary spending, so there you have it. Income statements in a nutshell. They're a powerful tool for understanding the financial health of a business. Income statements in a nutshell. Whether you're running a small lemonade stand or a big company, understanding this financial statement can help you keep track of how well you're doing. Whether you're running a small lemonade stand or a big company, understanding this financial statement can help you keep track of how well you're doing. Thanks for watching. If you found this helpful, don't forget to like and subscribe for more simple finance tips. See you next time.